any apologies?
Good morning, Chairperson and members. No, Chair, we don't have any apology.
All right, thank you indeed. Over to you, Yanga, and your team. Is Yanga here?
Good morning,
Yes,
Chair. Yes,
Chairperson.
we are here.
Hello, my friend. How are you? Nice to see you. Good, good. Let's get going. We've got
Okay,
the
thank you.
presentations. Yeah. Welcome to you and your team and whoever else is here from civil society. All right, over to
Okay.
you. Thank you.
Okay, thank you, Chair. Lungisi, can you please go to the first slide? The second one, with that one, not the second one. The second slide, Mlungisi. I think we can continue. Today, we are doing all the 4 2022 tax bills. The second slide, Mlungisi, yes. So in terms of the process, Chair, we are coming to the SECOF on the 18th of October after we have done the response document to SCOF. So our presentation will also include the proposed changes based on the public comments received. But we're not going to deal with the comments in our presentations, but just to say that these are the proposals included in the draft TLAB.
Yeah, no, we value that. Thank you. Yeah,
yes.
Good.
Lungisi, next slide. Overview of the 2022 tax legislative process. We've got the 2022 draft rates bill, which contains the tax announcements made in the 2022 budget, and it deals with changes in the rates and monetary thresholds, as well as excise duties on alcohol and tobacco. It also contains, Chair, the changes tabled by the Minister on 31 March and 31 May regarding the temporary relief on fuel levy, as well as the postponement of the effective date of the increase in the health promotion levy. We have also got the 2022 draft revenue laws amendment bill. This bill contains the proposed changes to the two-pot, in terms of the two-pot retirement system, is that these are the changes in the Income Tax Act. But this year, we've decided to put them in the separate bill because there were a lot of changes. As such, the draft revenue laws amendment bill, it won't be included in the bills that will be tabled by the minister during MTPPS, as we still to do some consultative work before we can finalize the changes in the draft revenue laws amendment bill. The last one, Chair, is the last two bills, 2022 draft TLAB and 2022 draft TALAB. Those are the usual tax bills that deal with more complicated tax proposals that are included mostly in Annex C, as well as Chapter 4 of the 2022 budget review. Next slide, Mlungisi, slide 4. As you know, Chair, in terms of the constitutional requirements, the tax bills have to be split into 2 separate bills. Slide 4, Mlungisi. They have to be split into 2 separate bills, the money bills as well as the administrative bills. And then the money bills in the 2022 tax legislative process are 3, is the rates bill, is the TLAB and the revenue laws amendment bill, and the administrative bill is the TALAB. As indicated, in terms of the consultative process, this indicates that we have gone through the full public consultation process and you have taken into account the requirements regarding the public consultation process. The rates bill was first published on budget day on 23 February, and it was again published on 29 July, when we are publishing other tax bills for public comment. The closing date for public comment was 29 August 2022. We briefed the Standing Committee on Finance on the 2022 draft tax bills on 23 August 2022. On 8 and 9 September, we held workshops on the draft TLAB and draft TALAB. And then on 12 September, as well as the rates bill. And then on 12 September, we had workshops on the draft revenue laws amendment bill. That required a special day because there were a lot of comments that we received on the two-pot system. Hence, we said that it has to have a special day for public consultation. And public hearings were held at SCOF on 13 September for the draft revenue laws amendment bill, that is 2 pots, as well as the draft rates bill. And then on 14 September, there were public hearings on TLAB and TALAB. On 20 September, we did the response to SCOF on the rates bill, as well as the revenue laws amendment bill. And then on 21 September, we did the response to SCOF on TLAB and TALAB. As you know, Chair, after responses to the SCOF, we are in the process of making changes in the tax bills prior to the formal tabling by the Minister in Parliament during MTBPS. That is slide 5, Mlungisi. And then it is important, as indicated earlier, it is important to note that the draft revenue laws amendment bill dealing with the 2 pots will not be included in the 2022 tax bills to be tabled by the Minister during MTBPS, as we still need further consultation in this regard. So the likelihood is that after the consultation process and after we have made amendments, it may be tabled during budget 2023. And then today, Chair, we are briefing the SECOF on the key issues included in the draft tax bills. And then we're gonna start with the draft rates bill, increase in excise duties on alcohol and tobacco. I'm gonna hand over to Mpho. Mlungisi, I think you have to allow Mpho to be the co-host, as this part is almost his. Can go to slide 11.
Good morning, Chair, and good morning, honorable members. I'll just take you through the changes to the excise adjustments that were made in the budget for this year. The Minister announced increases on excise duties on alcohol and tobacco that range from between 4.5%, which is an inflationary adjustment, and 6.5%. That came in the backdrop of 8% increases that were made in the previous year across all the excisable products. This year, the changes were about 4.5%, between 4.5% and 6.55%. Next, Mlungisi. Next slide, please.
You can continue because I mean we've got it.
Okay, I think the parts on the excise duties is done. Charlene will deal with the fuel increases for this year. Thanks.
Thanks, Mpho. Chris, are you in the meeting?
Yes, I'm here.
You can go ahead, thanks.
Okay, thank you, Chair. Thank you, members. We did make some changes to the general fuel levy after the budget, which we have then included in the rates bill as well. This was to try and alleviate some of the price pressures from the very large increases in petrol and diesel that occurred after the Russia-Ukraine conflict. Initially, there was a 2-month reduction in the general fuel levy by R1.50 per litre from for April and May. And that was going to cost around 6 billion in foregone revenue. And it was going to be funded through a sale of strategic oil stocks through the DMRE. After the 2-month period, the prices were still very high. So we extended the relief for another month of R1.50, and then for another month where there was a 75 cents per litre reduction. If you go to the next slide, that was going to cost around 4.5 billion, which was then going to be incorporated into the fiscal framework in the MTBPS. So in effect, there were 4 months of general fuel levy relief provided, and it came to an end after that point. Luckily for us, I suppose, the oil prices did come down quite a lot at the end of that 4-month period. So actually there was still a reduction in the price, even though the fuel levy relief did come to an end. Thank you.
Sorry, what's going on? Younger, who's next?
And next
Hello.
slide. Next slide. Thank you. It's back to the health promotion levy. Paul?
Okay, thanks, Chris. In the budget this year, the minister announced an inflationary adjustment to the health promotion levy, and the effective date was going to be the 1st of April this year. But after consultation with the ministers of trade, industry, and competition, and also the minister of agriculture, the minister announced a postponement of the effective date to next year, and also in the budget, the minister announced a review process that will be undertaken on the health promotion levy, looking at the threshold and also the inclusion of 100% fruit juice. You will recall, Chair, that when we implemented the health promotion levy, 100% fruit juice was excluded from the first phase of the implementation of the health promotion levy. And again, with further to consultation on the health promotion levy, the implementation date will be moved to the 1st of April of 2023. Next slide. Thanks.
Okay, thank you, Chair. As indicated earlier, the biggest part or the biggest proposals in the 2022 legislative cycle is the two-pot retirement system. So I'm going to hand over to Basil Maseko and Alvina Taylor. They are the ones that are doing the policy on this, so that they can take you through the background that way, and as well as the text proposals that were included in the TLAB, as well as the proposed changes to be made after the bill has been published for public comment. But as indicated earlier, this is not going to be tabled by the minister next week during MTPPS. Over to you, Basil. Lungisi, please move the slide.
Good morning, Chair and the committee, and thanks, Yana. So the two-pot system, it's a system that we want to create in order to enable fund members to have some kind of access to their retirement savings. So this came about as a result of COVID. So if you remember, during COVID, a lot of people were laid off or put on a, well, they were not being paid, but I think they were sitting at home not doing anything, so they're not getting any income. So we started off by announcing this. Minister did make an announcement in February 2021, and in excuse me, in November MTVS about what's going to happen. And then we issued a paper in December trying to narrate what the structure might look like and what the pros and cons of each of the proposals we had would be. And then the two-pot system is going to be available for basically all type funds. So you're talking about pension funds, your preservation funds, provident funds, pension preservation funds, and retirement annuity funds. And basically the structure of our retirement system would remain the same, which means when somebody makes a contribution, the contribution is exempt, the growth during contribution would be exempt, and tax will only be payable when a withdrawal is made. And then the contribution rates would remain the same at 27.5% of remuneration, or up to 350,000 per year. The proposal was to kick off the two-pot system as of March 2023. So that's what the current law, current draft bill says as it is at the moment. Move to the next slide. So what is the savings pot that we are creating? So we didn't want to allow seeding in the system. So seeding meaning that we make available an amount that would be accessible by fund members immediately when this two-pot system kicks in. So it would come from what is already there in the retirement system. And then going forward, the contributions, when a member makes contributions into a retirement fund, the contribution will be split into 1/3 and 2/3. The 1/3 is going to go into what we call a savings pot. And then any contributions in excess to the allowable deduction will not be permitted. So what you contribute out of the 1/3 will remain that 1/3. You can't put in any extra. Then the minimum withdrawal from the savings pot would be 2,000 rands. So if you have a balance that's less than 2,000 rands, you wouldn't be able to make any withdrawal until you get to that minimum of 2,000 rands. And then we are also going to allow a kind of a rollover. So if somebody hasn't used that 1/3, they would be able to use it in any future year. They'll be able to withdraw it immediately in any future year. An individual will also be allowed to would be allowed to. Sorry, can I go back? So I was saying an individual would not be allowed to withdraw within a 12-month period. So we'd have a 12-month cycle in which you would be able to withdraw. And then on the death of an individual or on retirement, an individual would be able to take what is in the savings pot, subject to the retirement lump sum tables. And then we had in our draft bill that the withdrawals will be subject to the rules of the funds that allows the two-pot system. I can go to the next slide. And then the other pot that goes along with the 1/3 is the 2/3, like I said, which we call a retirement pot. Then all contributions not allocated to the savings pot will go to that pot, to this retirement pot. That's basically breaking whatever contribution into the two pots, 1/3 and 2/3. And then the current amount for purchasing an annuity that is at the retirement of 167,500 would apply to the retirement pot. Remember, I think I said the savings pot can be withdrawn at any time or even at retirement. It's still subject to, at retirement, it would be subject to tax. And then an individual would be allowed to transfer available funds from the retirement pot to another retirement pot, and that transfer would be tax-free. But you cannot transfer from a retirement pot to a savings pot. Yeah, I can move on to the next slide. the two-pot system would create what is called a vested rights pot. So for people who are in a provident fund and started contribute, well, who are more than 55. Okay, let me start all over. Well, all contributions and growth prior to implementation date will have to be evaluated on a date prior to the implementation date. And then this amount that's going to be valued is going to be called a vested pot. It will consist of the total retirement interest of the fund that exists immediately before the implementation of the two-pot system, and the growth that would have that would occur in that pot. So for no contributions will be made to this pot, the vested pot, after the implementation date, except in the case of people who are 55 years and more as of the 1st of March 2021 and belong to a provident fund. An individual will be allowed to transfer available funds from the vested pot only to another vested pot on a tax-free basis. When an individual ceases to be a tax resident, they will, for an uninterrupted period of 3 years, then they can take it after that period of 3 years. The rules of the fund would be applicable prior to the implementation of the two-pot system will apply in this regard. Move on. You can move on to the next slide. So that is basically what we had in the draft bill. You can move on to the next slide. So what we're going to present now is, having had comments from members of the public and the industry at large. These are the proposed changes that we are going to make in a new bill that will be coming. So the first change is, we had initially set the proposed date to be the 1st of March 2023. So we're going to move it further out to 1st of March 2024. That's a year from now. And then this seeding. Remember, I said seeding is allowing money that can be made available for immediate access in the savings pot. So we are also going to make amendments to that, so that there is some seeding that's going to be allowed into the savings pot. And then I think it wasn't clear in the first draft whether the two-pot system is going to be optional or not on some funds. So we're going to make it compulsory that make it clear that it is compulsory, it is mandatory for all funds to create the two-pot system. You can move on. And then we had a lot of comments on how the system is going to be applicable on DB funds, defined benefit funds. So we have embarked on a consultative process to talk to the industry, the DB fund sector of the retirement industry in this week and next week. And then there was also an outcry about retrenchment, given that South Africa has a very high unemployment rate. So we are going to make amendments to allow access to the retirement pot of the two pots for members of retirement funds who have a UIF benefit. So they have to exhaust that UIF. Firstly, they have to exhaust their savings pot, and then secondly, they have to exhaust their UIF benefit before they can access the retirement pot. Then the transfer between funds. We'll also make clarification on the 22 revenue draft bill that the various pots are components within a relevant fund. So as such, when transferring from one fund to another, all pots need to be moved together. You can't transfer one fund and one fund, say the savings pot, and leave your retirement fund in another fund. And then further clarification will also be made to the bill about the transfer of any other nature, which would be permissible when membership is terminated. Can move on to the next slide. Next slide. Okay. Fine. And then no, just go back, please. So I think there was also confusion about the impacts of the two-pot system on at retirement on the minimus, which is the minimum amount that we need to buy an annuity. So yeah, I think it was our intention that the minimus will apply on a cumulative basis to amounts subject to annuitization. So the new proposed draft bill will be amended to reflect our intention. And then the impact of the retirement, the two-pot system on transfers, on deductions rather. Government acknowledges that there will be a need to make amendments to Section 37D of the Pension Funds Act to cater for the two-pot system and to ensure that the deductions are catered for both the vested and retirement pots from a member's fund. Application of the two-pot system on legacy funds. Remember, I think there are what's called legacy funds, especially in the retirement annuity fund industry. I think they're also called all generation retirement funds. So yeah, I think we have to also embark on a consultative process with the industry as to how the two-pot system can be applicable to those all generation retirement annuity funds. Move on to the next slide. And then for people who were over the age of 55 and belong to a provident fund, the policy intention is for provident fund members who are or were 55 and or older as of the 1st of March 2021 to have a choice as to whether they want to belong to well, was the one to have this two-pot system applicable to them or not. We want to create this option because they are close to retirement. And then as it relates to the T-day vested rights and the newly defined vested pot, the policy intention is for the vested pot to be an accumulation of all vested and non-vested earnings prior to the two-pot system being implemented. And then deductions of costs under the two-pot system. So I think it wasn't clear in the previous bill as to whether deductions are going to be included, whether the 2,000 minimum withdrawal is before or after deductions. So the clarification will further be made as to what the intention is in the bill. Okay, move on to the next slide. And then it was also not clear what we meant by a 12-month period. So I think what we make clear is that what we wanted to have is a 12-month rolling period. So I think the question that was asked was, what do we refer to the 12 months? Some were saying, are we talking about the tax year, financial year, or whatever year we were talking about? So we'll make that clear. And then the minimum withdrawal amount from the savings pot is a gross amount, not a net amount. So the new bill that's going to be coming out will also make this clearer. And then small balances in the savings pots, we will also cater for commutation of small balances from the savings pot when members exit the fund. So if you have taken your 2,000 rands, say early in the year, and then you exit the fund, excuse me, later in the year, and then whatever is left is a small amount that person should be able to, within the 12 months, be able to withdraw whatever balance that remains in the fund. Next one, slow. Thanks, Jim.
Okay. Thanks, Basil. The minister in the 2019 and 2020 budget made announcement regarding government's intention to start taxing electronic nicotine and non-nicotine delivery system. And last year, Treasury published a discussion paper outlining the policy design for taxing electronic nicotine and non-nicotine delivery system. In that proposal, we had envisaged applying an excise tax on the nicotine content and the liquid solution on this nicotine, electronic nicotine and non-nicotine delivery system. But through the consultation process, the comments that came from stakeholders was that system will be quite complex to administer. Therefore, we will need to implement a flat rate that doesn't take account of whether these products have nicotine or not. And in the budget this year, the minister announced a flat rate of R2.90 per milliliter of this nicotine solution to be implemented from January next year. Upon further consultation with the South African Revenue Service, the decision was taken to postpone the implementation of the tax on electronic nicotine and non-nicotine delivery system to June next year, so that the administrative system for the tax can be put in place. The legislation, therefore, that gives effect to this is included in the taxation law amendment bill, which make changes to the customs and excise schedule for the provision of taxation of electronic nicotine and non-nicotine delivery system. Thank you.
Charlene, over to you on carbon tax.
Thank you, Yanga. Good morning, Chair and honorable members. So we'll present briefly a background on the carbon tax policy and then touch on the proposed changes that were made in the TLAB. We can go to the next slide. So by way of background, the process on the carbon tax started in the late 2000s. And after an extensive consultation process from around 2011, the carbon tax bill was signed into law by the president in May 2019. So the carbon tax came into effect on the 1st of June 2019. It forms part of government's broader policy response on climate change and is a key part of our national development plan in terms of recommendations of the carbon tax being a cost-effective instrument to help achieve emission reductions. Overall, it seeks to give effect to the polluter pays principle and to internalize the externality costs of climate change and to make sure that they are taken into account by producers and consumers in terms of their choices around investments and consumption. The tax will play also an important role in terms of achieving our commitments under the Paris Agreement, which South Africa has signed up to. Next slide. This slide just summarizes the design of the tax, which may be very familiar. So currently the rate of the tax is around 144 Rand per ton of carbon dioxide equivalents. The tax was designed in a way to provide transitional support measures and assistance to industries as they start to transition their activities. So there are allowances ranging from 60 to 95%, covering combustion, fugitive, and industrial process emissions. Process emissions, for example, from the iron and steel sector, cement, chemicals qualifies for a maximum tax-free allowance of around 95%, with electricity-related emissions qualifying for a slightly lower allowance of 90%. So this just takes into account the difficulty to reduce emissions because they are intrinsic to particular process. So overall, the effective tax rate currently is ranging from around 6 to 50 rands. And then a key part of the design of the tax is that it includes revenue recycling measures to help cushion the impact on households as well as energy-intensive businesses. So there are two specific incentives that are in place. There's the energy efficiency tax incentive, which was introduced in 2013, and then electricity generators like Eskom are allowed to offset their electricity generation levy payment against the carbon tax, as well as any purchases of renewable electricity that can also be offset against their carbon tax liability. So effectively, that significantly reduces their liability with no impact due to the carbon tax on the price of electricity in the first phase. So that's broadly the design of the tax. Next slide. So from the time this tax was put forward as a policy and currently now in 2022, there's been significant developments in terms of our climate change policy. So we have made commitments under the Paris Agreement and put forward specific targets to reduce our emissions in our nationally determined contributions for the period up to 2025, and then from 2026 to 2030, we've committed that our emissions will peak in 2025, and then it will decline quite drastically from 2026 to 2030, and this will be in the range of emissions of around 350 to 420 million tons. As part of our NDC, we mentioned the various policies that are implemented in South Africa. So this includes the carbon tax, but it also includes proposals around implementing sector emission targets as well as carbon budgets, which are basically limits on companies, which is under development by the Department of Forestry, Fisheries and the Environment. We also have the National Climate Change Bill, which is being processed through Parliament. And we have various sector-based strategies, but we just thought we'll also mention that there's the process of the Presidential Climate Commission around the Just Transition Framework, as well as the initiatives around the Just Energy Transition Partnership and Investment Plan to enable South Africa to access climate finance in order to facilitate the just transition, focusing on the electricity sector. And then lastly, in terms of the broader context around the climate response, we have published a green finance taxonomy, which looks at classifying investments and green and climate-friendly investments to prevent greenwashing in the sector. Next slide. This just shows that the climate risks and impacts are real. It's being experienced currently. We've had the recent flooding, droughts that we've experienced, as well as the severe storms in the KZN region, and the costs of responding to these impacts are also escalating, with the frequency of these events likely to increase in the future. Next slide. Just to make the point on this slide that the carbon tax is a key policy measure in helping to facilitate a just transition. It aims to internalize those externality costs of climate change that are currently externalized and close that price gap between high carbon emitting products and low carbon emitting and more energy efficient products and production processes. It does not set a limit on the amount of emissions over the short term, but over time, as the tax rate increases and it is phased in, it will start to provide a very strong price signal for changing in behavior across the economy. As mentioned, the design of the tax does provide transitional support measures for households and businesses, and the future development of the tax-free allowances on the under the tax will be dependent on our commitments under the Paris Agreement, which are expected to become stronger from 2031 onwards, and the progress that we make in terms of reducing our emissions. There are also the significant risks of border carbon adjustments, which has been put forward by many developed countries. The European Union has put forward proposals for a carbon border adjustment and several other developed countries. So as we go forward, there is a risk with our carbon intensive exports being subject to border adjustments when they are exported to the EU. So there's a significant incentive for business to start to decarbonize earlier and to reduce their emissions over time to remain competitive as we move forward. Next slide. So the proposals in the 2022 budget, firstly, they provided for an extension of some of the revenue recycling measures, which is the commitment to electricity price neutrality, as well as the energy efficiency savings tax incentive for an additional 3 years in order to assist companies' transition, as well as aid the economic recovery. And coupled with this, from 2026 onwards, taking into account our commitments under the Paris Agreement and more stringent commitments around meeting the 1.5 degree temperature goal. It includes proposals for increasing the carbon tax from 2026 to 2050 to strengthen the price signal. This is intended to help assist with the structural transformation that we need to make in the economy across the different sectors, and to provide a policy certainty to companies on the carbon price path over the short, medium, and longer term, and assist in guiding some of their investment decisions. Next slide. So the specific proposals on the carbon tax rate trajectory based on the announcements that was made in budget for the period 2023 to 2025. It was proposed that the rate of tax is increased by $1 US, $2 US, and $3 US per ton CO2 equivalent over the period 2023 to 2025. For 2026 and 2030, there are specific proposals for the rate to increase to $20 US Rand equivalent in 2026, and then $30 US in 2030. And for the period 2027 to 2029, it was proposed that the rate increases by $2.5 US per ton CO2 per year in that period. Next slide. As mentioned, we propose the extension of the deduction for electricity price neutrality for an additional 3 years. It was supposed to come to an end at the end of this year, but it's been extended to December 2025. In addition to that, we announced in budget a clarification around which specific activities qualify for this deduction in terms of the international codes that are used for defining these activities. So we clarified that this applies for energy industries and manufacturing industries and construction. Next slide. And we, as mentioned, we announced the extension of the energy efficiency tax incentive by 3 years to end in December 2025. Next slide. This is a bit of a complicated one. So in the Carbon Tax Act, we allow companies to deduct emissions that are sequestered, and this applies to the pulp, paper, and print industries, and it also allows for where the sequestration is done or emissions are stored in trees, and then secondly in harvested wood products. So this was a change that we made last year to clarify this deduction, and to tighten up on the administration of the system and prevent potential abuse and double claims of this allowance. We proposed in budget that this deduction is limited to activities that is within the operational control of a taxpayer. Next slide. Okay, so the next few slides covers the changes that were made in the TLAB based on the public comments that we received. Next slide. So there were concerns in the public consultation process around the reference to the carbon tax rate and this being reflected in US dollar-based rates. There were concerns around the potential volatility of the Rand-dollar exchange rate and possibly higher rates of taxes being implemented. So to provide that policy certainty around the rates, it's proposed that changes be made to the 2022 draft TLAB to shift from the US dollar-based rates and to reflect the rates in the Rand equivalent amount. This will use the average exchange rates published by the South African Reserve Bank, and the period that was chosen for this exchange rate was August 2021 to end of July 2022. And in the next slide is the specific rate changes. We also propose that there are periodic adjustments to these rates to take into account global carbon pricing developments and noting developments around carbon border adjustments. So the rates basically the headline rates range from 159 Rand reaching 308 Rand per ton CO2 equivalent in 2026, and then 462 Rand per ton CO2 equivalents in 2030. The effective rates are much lower because of the tax-free allowances and other deductions that are also applicable. Next slide. On the electricity price neutrality extension, there were comments around extending this deduction to also include activities classified under commercial and institutional and the agriculture and forestry sectors. It is proposed that changes be made to the TLAB to basically cater for this extension, and it will align the tax treatment of similar activities under the carbon tax. And then the second proposed change was that there were requests to extend the sequestration deduction beyond the paper, pulp, and print sectors, but to also include the sawmilling activities. So it is proposed that changes be made to the 2022 draft TLAB to extend this deduction to include the 182J activities, which is forward and wood products. The concerns around potential abuse of this system is reduced because there are specific guidelines that have been developed by the Department of Forestry, Fisheries and the Environment around verifying these emissions, as well as the industries working on a specific protocol to basically register some of these timber producers and verify those emission savings for those activities. Next slide. Thank you. Thanks, Yanga.
Thank you, Charlene. Chair, the carbon tax was one of the biggest tax proposal after the two ports that we received a lot of comments. And as you can see, we have tried to accommodate most of the comments. The next one that we're gonna go through is the changes to the 2022 draft TLAB on income tax, individuals and savings. Over to you, Zalisile. Thank you.
Thank you, Yanga. And thank you, Chair and members of Parliament for giving me this opportunity to deal with the income tax, individuals and savings and employment technical amendments that were introduced by the Minister of Finance in the budget. Next slide. Chair, this issue is with regards to the list that we have on Section 7 Cap B that is dealing with variable remuneration. Section 7 Cap B is a special dispensation for variable remuneration, and what it does, it defers the tax on variable remuneration to the date when the amount is received by the employee, as opposed when it accrues to the employee. And what we have seen is that even though we have commission on the list of variable remuneration in Section 7 Cap B, that list only caters for formal sector performance-based payments that form part of the employee's salary. But it does not cater for the informal sector. That's what we have seen, is that in the formal sector, you have commissions that are percentage-based when they are paid to the employee by the employer. But in the informal sector, there are instances where employees are only paid when they have met a certain condition. And that condition should be how many units have they produced. For example, I will make an example of a farming employee who is only paid on commission basis on the number of boxes that they are packing. That is not based. That is based on calculating the amount of variable remuneration that is subject to tax on a percentage basis, but is on the basis of how many units of boxes have they produced. So this year, we looked into the informal sector, and we proposed to amend the definition of variable remuneration in Section 7 Cap B. Next slide, Mlu. So after we had the public consultation process, there was general consensus that even though there are occurrences in the informal sector, we need to look into the issue of performance-based payments that are actually subject to a fulfillment of a suspensive condition. What this means is that as the farming employee has packed the boxes And these boxes now, they need to go to the second or to the next level in the process, in the production process. That box has to be reviewed or has to be quality checked by a superior employee before that box is shipped out to the market. So it has come to our attention that there are instances where there is a variable remuneration that is paid to the employees based on their performance, but only on the units that they are producing. And on the basis of that, we put instances where we allow employees who receive remuneration for their tax to be only withheld by the employer when that suspensive condition has been met, when that quality check has been fulfilled and the box is ready to go to the market. And also another change that we made based on the public consultation process we had, the public felt that we should also include a provision in the Income Tax Act where an employee passes away before they receive their variable remuneration. So what would happen then? When would be the date where the employer has to withhold PAYE? So the consensus was that it should be the variable remuneration now that the employee is entitled to should be before the date of payment. And the accrual date of such payment shall be deemed to be the day prior to the employee's death. So if an employee is entitled to variable remuneration and that employee dies before they receive the payment, then the accrual date of that particular payment will be deemed to accrue to that employee on the date prior to their death. Lou, can we go to another slide? Yes, Chairperson and members of Parliament. This one is with regards to the 2022 TLAB technical amendment proposals that were made. Particularly when someone or a taxpayer or an individual ceases to be a South African taxpayer or ceases to be a resident for South African tax purposes. So what we have seen is that in 2012, a clarification was made to say that if a taxpayer or an individual ceases to be a South African tax resident, that individual year of assessment is deemed to have ended immediately before the day that taxpayer ceases tax residency in South Africa. And further to that, it said that the individual next succeeding year of assessment would actually commence or deemed to commence on the day which the tax residency has ceased. So here we actually tried to introduce an anti-tax avoidance mechanism to say that what we see that is there's a potential loophole or a potential abuse that can take place, especially when one has 2 years of assessment during a period of 12 months. Let me make an example. In the first 6 months, they were tax resident. In the second 6 months, they were not tax resident. But what happens now when they double up on the exemptions and exclusions? Exemptions, the exemption I'm referring to is in section 10(1)(I), which deals with the interest income. There is a relief there that is given in the tax legislation that says if an individual or a taxpayer who is at least 65 years of age, the first 34,500 is not going to be taxed in their interest income that they receive. And if all individuals below the age of 65, those individuals will be allowed an exemption of 24,800. So what in this instance is that what we are trying to do is to close the gap so that people are not able to double up. In the first 6 months, you get the full exemption. when you are a tax resident, in the second 6 months, you get the full exemption again, of which the exemption is only for an annual period. So the proposal was that we have to amend section 10 and paragraph 5, which deals with the annual exclusion. When an individual has sold a capital asset, then capital gains tax comes into play. So paragraph 5 gives a relief there for individuals of 40,000 rands, and on the year that they die is 300,000. Can I have a second slide, another slide? Thank you. So after the public consultation process we had, there was consensus that, okay, this is a sensible anti-avoidance measure. But what needs to happen is that we should not apportion the annual exclusion on the basis of the number of days. We need to make it simpler and more flexible. As taxpayers will utilize those relief as it best suits them. And that we are not going to now apportion on a number of days. We're only going to apportion on a 12-month basis, just to make it simpler and provide greater flexibility and be able to achieve the policy objectives. Next slide, Mlu. Thank you, Mlungisi. Chairperson and honorable members of parliament, this one deals with the review of reviewing the transfer of total interest in a retirement fund. This one had to deal with when we're looking at a retirement annuity fund that has multiple contracts within that one retirement annuity fund. So what happens here is that the Act make provision for members of retirement funds, firstly, to transfer their retirement interest from one retirement fund to another retirement fund. And the transfers are subject to conditions. And these conditions result in retirement annuity fund members with one or more contracts in a particular retirement fund being restricted from transferring one or more contracts from one retirement fund to another. The major issue here is that is an issue of uniformity, a very important and a major tax policy principle, which says that similar amounts or similar individuals individuals who are in a similar kind of positions in terms of tax consequences, and then there should be actually a similar treatment in terms of tax as well. That's what uniformity actually means. And that we have seen that members of pension actually preservation funds are not restricted as members of retirement annuity funds. So we want to align this so that members of retirement annuity funds can transfer one or more of the contracts in a particular retirement fund, but subject to conditions. And one of those conditions is the de minimis threshold, which currently sits at 247,500. Next slide, Mlu. So when we introduced the 2022 draft TLAB, we had thought that it will give them greater flexibility, the members of retirement annuity funds who wants to transfer one or more contract to another retirement fund, by doubling the current de minimis threshold from 247,500 to 495,000. But what we got to see and consider from the public participation workshops is that that amount is quite too high, and it would be better if we reduce it. So we actually reduced the amount but we kept the flexibility that we had introduced earlier to say that we would like to increase that de minimis. And with that de minimis was increased by a multiplier of 1.5, which now gives a proposal that is standing at 371,250,000. What another change that is going to be made is one that clarifies that if a member of a retirement annuity fund wants to transfer the whole amount, the whole thing, that transfer is that the de minimis, it will not apply in those instances. Thank you, Mlu. Next slide. Thank you, Chair.
Yeah, Yanga. Yanga, are you here?
Yeah.
Sorry, sir. You know, normally you give us a separate presentation on each firm, right? Because as it is, they're very technical to deal with. I let
Yes.
it carry on because of the complexity of what you're saying, which I don't even fully understand about the
Yes.
withdrawal of TLAB bill and so on. But I am getting a bit worried about our capacity to absorb. So I just want some direction. I think because you've got to where you have, you know, maybe you should finish. But if I'm correct, you still got a long way to go. So I just want some guidance from members. Are we all still here in the full sense? And I can tell you now, you see, you are tax people, right? You are experts. We are mere politicians, right?
Mm.
And you must remember, you know what? It is very difficult to deal with one tax bill and then to deal with all of them flowing one into the other is very challenging. Now, I just want some guidance from members. Can we let them finish? I think we should, but I just want some guidance from members. It's you who will decide as a majority. What is the feeling of the meeting? Must we ask them to round up at some appropriate point, or must they finish the whole thing now?
Chair, can we
They have
allow
no
them
views. They have no views, so you know what? Carry on speaking. Until some of them express their views, nothing I can do.
to have said something, Chair?
Oh, yes, yeah. Is that Sekoa chairperson? Yes, chairperson.
Chairperson,
Sorry.
can we allow
Yeah.
them to finish?
Finish. Okay, go right ahead then. Fine.
Chairperson, Honorable Ryder's hand is up.
Oh, I don't see it. All right. In Kulilek, you meant to help me because I'm not always very fast at this. Yeah, okay, Mr. Ryder.
Yeah, Chair, it almost seems as if Treasury came with an agenda to put us to sleep initially and then hit us with the rest of the info a bit later. The start of that was very tedious. You know, I mean, I'm a very bad guitar player, but my wife allows me to play guitar at home. But you know, when I start singing, she tells me
And
to
I'm
shut
a
up.
very bad singer, yeah. Mm.
Indeed. So I think, you know, we should play to our strengths sometimes. And Treasury has not done that today. We've had some very tedious presentations. But Chair, look, having said that, we're about halfway through. I do think that there's important stuff coming. I also believe that a lot of what we're absorbing now will be fleshed out in the public participation and so on. So I think as much as we need a bit of a wake up, and maybe everyone should jump up and turn around 3 times and sit down again. But beyond that, I believe we really should continue.
All right, fine, let's go. Go for it, Yanga. I don't know that you're holding great store by public participation. We don't get much of it for tax bills, but anyway, maybe you're wrong. Maybe I'm wrong and you're right. Fine, go ahead, please. But can you, if I may say so, look, if the majority disagree with me, please just put your hand up and say so. I'm finding it quite difficult to follow. That's all I can say. So can you focus on the key issues and not become over technical, if there's such a thing you can do, not go through every line. Because remember, well, some of us anyway, let me speak for myself. I can't speak for others, okay? Each of us is different, even in the same party. So for me, I like to get a briefing properly first before I go through all your documents. So I browsed through it this morning. Frankly, I found it quite difficult, but anyway. And then I thought, let me hear you. And then, you know, when I get some time before we meet again over the weekend, then when people come in the public participation, they sometimes help as Dennis says, but we don't get many of them anyway. All right, you can go ahead, but please don't go through every line. Just pick up on the key issues, the key policy issues. Thank you.
Okay, I think, Chair, from the individual tax, because the last three, the changes were accepted. So after the public consultation process, no changes are required to be made in the 2022 draft TLAB. So I think, thank you, Zadisile. I think the biggest one on individual tax are the ones that we have made. And then because all the last three were not controversial, the changes were accepted. So in order to move faster, and then we're gonna go to the business income tax, general business tax. Thank you, Zadisile, about that.
Yeah, just one more thing I need to say. I'm not sure if Poppy Ntaka is back. And she's here. Welcome back, Poppy. Obviously, you will do a coordinate with Esther and Koleleko. You will do an overview before we, well, maybe we can wait till the public hearings. We'll leave it to you, but you have to do an overview independently of these issues, highlighting the key policy issues for the committee from the side of Parliament, right? As you have to do on every bill that gets to us, you and your team. So Poppy's on board, which is quite good. I wasn't sure whether she came back. She was in leave. And by the way, Poppy, you have to report to us your result. And if you get anything less than 80%, I think you know the rules in this committee, right? You will be handed over to Simon Moletsane for disciplinary purposes, okay? and funny. So I hope you got your first. I'm sure you have, but anyway. That was a joke, Poppy. Don't get upset now. Joke. And by the way, when you're dealing with tax, Poppy, at least I can only speak for myself. You really have to be a bit lighthearted at the complexities. Otherwise, you'll have a nervous breakdown. And the little hair that I've got, I'll have to pull it out. So fine, Poppy, that was merely a joke. I hope you understand that. Okay. All right, fine. Go for it.
Okay, thank you, Chair. I'll hand over to Arno on this one, but we want to highlight when we're doing the 2021 tax bills at the end of the year, there were two proposals whereby we postponed the effective date, whereby taxpayers came to Parliament. This one was clarifying the definition of contributed tax capital, whereby the effective date was postponed from 1 January 2022 to 1 January 2023. And then we said in the budget that Treasury and taxpayers must go and find at least a solution so as to address the issues, if there are any, that impact on the general business based on the proposals. So on the contributed tax capital, we did find the solution. However, there is another one of which we are sure that taxpayers will come to you. This one deals with the definition of collateral arrangements. In that one, we have had about 4 to 5 meetings with the taxpayers. However, we felt that no changes are required to be made in the legislation. We even had meetings with taxpayers and the regulator, Reserve Bank, because taxpayers were saying that there are issues regarding HQLA and all that. So on that one, we didn't do any changes in the legislation. So the changes that were in 2021 will continue when the effective date comes into effect on 1 January 2023. Over to you, Arno.
Thanks, Yanga. Morning, Honourable Chair, members and fellow colleagues. In short, we did make an amendment during the 2021 tax legislation period on the definition of contributed tax capital, or CTC as it is known in the industry, to look at certain tax avoidance schemes that were created because of the definition of CTC. So we endeavored to amend this CTC definition last year. There were various comments that we received during that period where industry said that they do acknowledge the abuse and that something needs to be done about it. However, there are certain legitimate transactions that are being caught in our new proposed wording. As such, we amended the effective date to 1 Jan 2023 to allow us to further engage with industry on the topic to get their inputs on it. So during the course of 2022 and with the draft taxation laws amendment bill in July, we moved away from a concept of the anti-avoidance measure together with those transactions that we would allow for it to a more general type, where we included a 91-day anti-avoidance measure rather, where you would test for CTC and equal distribution of CTC 91 days prior and post certain transaction to stop these avoidance schemes. We received feedback from industry saying, apologies, I don't know where I got cut off there. So we received input again from industry about our proposed 91-day rule, where they just said that they felt that the abuse would still be prevalent. And as such, Maluf, can go to the next slide. Not that far. Okay, well, you're right there at the end. So we had various interactions with industry and public workshops, where everybody was in agreement that we have to ensure that there's an equal distribution of CTC to all shareholders within the class, and that we will revert back to a system where we identify those specific transactions and distributions which should be allowable to assist companies with legitimate share buybacks or the redemption of pref shares.
Okay, thank you, Chair. I think on the business tax, that was the biggest one. And now I think we can swiftly go to another biggest one, which was the impact of Ifrs 17 on taxation of long-term insurers, or both long-term and short insurers. Lungisi, slide 67. This one, Chair, also needs mentioning because it's one of the biggest proposals. So I've skipped the one whereby you said that we should not be too technical. So I'm going to the big ones that we received a lot of comments and that those that were presented during the public hearings. So on this one is that this year we made changes to both short-term and long-term insurers as a result of the changes to Ifrs by introduction of Ifrs 17. So it is important to note that we have had about 4 meetings with the taxpayers. The first meeting, it was after the budget. And then we have meetings with individual insurance companies because they said that they cannot discuss their issues in one meeting. So after that, the bill was drafted. After the bill, we made changes to the bill and then we had workshops. And it is important to note that the impact on short-term is different on the impact from long-term insurers. On the short-term insurers, when we had our meetings with them, they said the impact is minimal, in others nil. But with long-term, others, they said, yes, they are still being helped by the changes that we made in 2015 when we moved from SEM to Ifrs 4. So that transition period and phasing in is still helping them. So there were about one insurer in particular, whereby the impact was going to be big. It is important to know that even in 2015, when we moved from SEM to Ifrs 4, there was one insurer that was impacted. But because when we make the tax legislation, we look at the general impact, not only the impact that is going to be felt by one insurer. During the public consultation, next slide, Undlandla is going to do the technical changes. During the public consultation process, we proposed that with regard to short-term insurers, there should be a phasing in period of 3 years. However, with long-term insurers, the phasing in should be 6 years. I know they're going to come through, Chair, because they went to the SCOF, because with regard to long-term insurers, they are proposing a phasing in period of 10 years. And our response was that, no, we can't have a phasing in period of 10 years because these provisions are still not yet in force. Then there should be a monitoring of the provision, and then we can see if it is important to extend the phasing in period from 6 years to 10 years. The next slides will be dealing with all the changes that we have made in the draft TLAB after they've about 4 meetings with the insurers. Over to you, Nhlanhla.
Good morning, Chair and honorable members. I think the key takeaway here is that what Ifrs 17 did was the restatement of liabilities for a long-term insurer and a short-term. So because there was Ifrs 4 that was having certain value, and now you have Ifrs 17, which also gives a certain value. So now, to the extent that Ifrs 17 exceeds the amount that was determined for the liabilities under Ifrs 4, then you have now that cash impact where now the insurers have to pay. And then Nyanga mentioned the 6 years for a long-term insurer that was given, and the 3 years for the short-term insurer. So that's, this slide talks to that. And then the next slide, Blue. And yes, the next one. So with respect to the short-term insurers, the key issue, what happened was we actually on the draft TLAB that was published, we focus more on the cash impact. So what now, the changes that we're going to do now after consultation was to take into account the terminologies that are under Ifrs 17, we are incorporating into the Income Tax Act. Also to take into account some of the changes that have actually emanated as a result of that, such that there are certain disclosure requirements that are under Ifrs 17 that were not there under Ifrs 4. So to cater for all of those things, that another change that were made here. Next slide, Lou. And then also this one is also in relation to the terms that are now in Ifrs 17 that are not under Ifrs 4. So we're changing that. And then the other one, the last one was also the disclosure requirements that was there under Ifrs 4, but it's no longer there under Ifrs 17. The next slide, Lou. Well, on this one, basically, for the short-term insurer, we were taxing them on receipt. So if they received some of the amounts from salvages or third-party recoveries, the short-term insurer, we will tax them on receipt. So now with the Ifrs 17, it's all accrual. So basically, that's a change that we're going to take into account. Next slide, Mlu. Okay, on the basically on the long-term insurer as well, it's exactly the same thing. The issue that they raised was the 6 years that Yanga talked to a bit. The issue there is that when we move from the statutory basis in 2016 to Ifrs 4, we gave the long-term insurers 6 years. And that also stems from the fact that we asked for the figures. So they will then send the tax impact and then we evaluate the figures. And then on that basis, we gave them 6 years. So even now, currently, it was also on the same basis. So we did exactly the same thing. And then, however, to the extent that maybe because some insurers are arguing that this impact is much bigger than the Ifrs 4 impact when we're moving from statutory to Ifrs 4, we're then saying that we will actually monitor that next year, given the fact that all of these insurers haven't actually submitted the tax return. And to the extent that the impact is big, maybe we may look into the 6-year period. Next slide, Blue. Okay, this one was more about the draft TLAB that was published. So the way we did the phasing in, so that the difference between Ifrs 17 and Ifrs 4 liabilities, it's the way that we did it on the corporate fund, and now we're using adjusted Ifrs fund, but this is just too technical. Look, we can go to the next one. Exactly the same as this one. The issue now was, one of the issues was that now it's what is happening under Ifrs 17 is that the premium debtors and policy loans are no longer separately disclosed. And hence now we're catering for them under Ifrs 17. So basically the key issue on this one, to sum up the impact of Ifrs 17 on the insurers, the long-term and the short-term, is basically one, to cater for the terminologies that have changed. Two, the amendment also relates to the cash impact that has occurred. So the difference between the old and the new, we spread over the period of time. And then lastly, to cater for some of the issues now, or some of the changes or the disclosure requirements that have occurred. And next slide. Okay. No, thank you so much, Yana.
Thank you, Chair. I think on income tax, the impact of Ifrs is the biggest one. And based on the fact that there's a difference on the phasing in, because we've proposed 6 years, they want 10 years, we are sure they're going to come to Parliament in this regard. So on the income tax side, as well as VAT, those are the biggest proposals that we have covered, which is 2 ports, vaping, carbon tax, health promotion levy, alcohol and excise duties, as well as Ifrs 17. So we're going to hand over now to France to deal with the key issues on TALAB. Thank you, Chair. Over to you, France, on TALAB.
Thank you, Chair. So thank you, Chair and honourable members, and thanks, Yanga, for handing over to me. So we're going to move on quite considerably. So probably about another 20 slides or so before we get to the bit that I'm looking at. I'll give you an exact reference in a moment. It is slide 98. Great, thanks. Moving on. So the question of what actually comprises an invoice has become a surprisingly contentious one in the customs and excise space. So the proposal was to clarify what is intended by an invoice. And so that was the proposal. And as you'll see from the list of clauses up in the heading, that there are a number of sections of the income of the Act that are impacted by this. So we got public comment, and if you move on, that public comment essentially indicated that we still needed to do some additional clarification. And so we've made it clear what it is precisely that we're talking about when we talk about an invoice. And we've rippled those changes out across the various sections of the Customs and Excise Act that are being proposed here. Moving on to the next. Now, one of the announcements in the budget is that we would be introducing an advanced ruling system in the Customs and Excise Act. Now, this is a little different from advanced rulings in the tax space. In the tax space, an advanced ruling is about how you interpret the law. So it gives you guidance on how you interpret the law. In the customs space, an advanced ruling is more about how you treat a particular type of product. So it's perhaps a little bit more specialized. And this is something that we have a commitment for in international agreements we've signed. And we've committed to have such a system in place by 2028. So we're putting the framework in place to allow us to roll that out. And obviously it has a number of advantages around providing certainty for trade. Moving on to the next slide. Okay, so where we got comments, there was obviously a little confusion as to precisely where these rulings were meant to apply, and we've made it clear we're talking about importers here because that's where the customs duties are generally applied. And there was some unhappiness with the basis of providing such a ruling, in that if you had not paid your debts with SARS or you had returns outstanding, that would take you out of the picture because you were not a fully compliant taxpayer. That was perhaps a little harsh. And so we've added something which we've used elsewhere in our legislation, which is to say, if you've made proper arrangements with SARS, so even if you still have that debt or that outstanding return, if proper arrangements have been made for payment or submission, then you are back in the system and you can get your ruling. There were some other concerns that were raised, but again, this is a framework that we're creating here. And there will be more detailed rules that will give flesh to the framework, so to speak, and we'll have public consultations around those rules. and those matters can then be addressed in that context. Moving on to the Tax Administration Act. And the next slide, please. Okay, so what we're seeing as SARS is that there's an abuse of the tax clearance status system that we have. So what people would do is they would quickly put in some null returns. Now they've submitted their returns, they have no tax debt, whilst they could put in nominal returns and pay the very small amounts due. But when we look at the systems and information that we have available to us, we can see that they're much more in the business of trade than they're telling us with a null return or a nominal return. So there's a mismatch now in our data. We can see this is a very active company or taxpayer, but on the other hand, they're putting in a null return quickly to get a tax clearance status. So what can we do? Now, the obvious answer is we go in, we audit them, but audit takes quite a while to get done. By the time the audit has been finalized and all the procedural steps that are required in an audit process have been completed, by that time the tenders are awarded, the payments have started flowing, and in fact the whole point of the tax clearance system has been undermined. We also see people generating new companies to take on particular transactions because a new company clearly has no history, and so then it gets a clean tax compliance status. So moving on, what we proposed to do was to allow SARS to revoke access if there was a material misrepresentation, non-disclosure, or potential fraud involved. And that's got a little bit of unhappiness. So we've clarified that it's a suspicion that we're talking about here. Something that a lot of commentators missed, but is I think reasonably clear in the law, and we've emphasized it, is SARS must give the taxpayer 10 days notice of the intention to revoke access to tax clearance status, so that the taxpayer can come back to us and say, no, you've misunderstood, you're looking at the wrong records, it's for another company, or whatever the case may be, that you demonstrate, in fact, they are compliant and that those null returns are justified. Again, we've accepted the comments that have been made that this is quite a serious power to invoke, and it shouldn't just be anyone in SARS who can do it. So we agree that's a very fair point and propose a change that only a senior SARS official can do this. And then when we come to the new companies, on our original formulation, we were looking at the period up until your first return or first payment. So either the due date, whether you made the payment or filed the return or not, because if you did, clearly you were compliant. If you didn't, then you were non-compliant. Or if you paid or filed a return early, then that would be the date that this notification that you were a new taxpayer would come off. The problem with that formulation is that there are certain specified classes of taxpayers who do not, in fact, have to file a return. And the one that comes to mind immediately would be someone who's subject to auto-assessment. You may ask, why does someone who's subject to auto-assessment with relatively simple affairs need a tax clearance status? Well, perhaps they've saved up enough that they want to invest offshore and they need tax clearance status in order to do that. So that's fair enough. And what we've added then is that there is a 1-year period after which you are no longer considered a new taxpayer. Just to flag something up, the fact that you're a new taxpayer doesn't mean you don't get a tax clearance status. You do. It's just a note to let anyone who's reading the tax clearance status know that SARS doesn't have the full information on this taxpayer yet because it is new, and that they can do whatever due diligence they think they need to do just to make sure that they are in the right space. Moving on to the next slide. This is a slightly technical one, but the way the legislation is currently formulated, SARS is not in a position to impose a penalty if someone puts abusive claims for the employment tax incentive in. That's a particular wording issue because we talk about reimbursements rather than refunds. And so the problem then is if there's no penalty for putting abusive transactions in, then there is clearly let's not say an incentive, but there's no disincentive for putting those abusive transactions in. And members will recall last year we were before the committee trying to tighten up the rules around some of the abusive practices we had seen. So these are a set of tweaks to ensure that those penalties can be imposed. Moving on to the next slide. So through the public consultation process, there was some discomfort in that the way the effective date clause was previously phrased, it looked like SARS would be in a position to impose penalties in respect of returns that were filed in the past, but where the audit was only being concluded now. So the effective date has, the suggestion is that the effective date be changed to returns filed on or after 1st of September 2022. So then it's clearly prospective. You know that there's a potential for a penalty. And if you decide to file the return in any event, well, then the normal consequences must follow. And then what was also pointed out is there was a potential for some specific penalties in the ETI system to overlap with the Tax Administration Act penalties. Again, a fair point. And the proposal there is to allow the one to be offset against the other so you don't get this doubling up. And that's it from my side. Thank you.
Thank you, Chair. Those are the key issues. We've come to the end of our presentation. Obviously, we have skipped some of the slides, of which they were too technical. But thank you, Chair. That's all.
Are you sure, Yanga? That's all? I'm just
100%.
joking. Okay, so over to the members. Anybody's hands up? Simon? Simon? Dennis?
Thank you, Chairperson.
Okay.
Let me acknowledge the presentation. My question to the National Treasury, it's about the illicit trading of...
Can somebody remove this thank you slide? I think the point's been made now. And Simon might think you're thanking him.
Can I continue, Chair?
Yes, my friend.
Thank you.
Please do.
I was saying my question is on the illicit trading of tobacco and alcohol. I just wanted to check with the National Treasury whether the government is managing to reduce or maybe to stop this illegal trading, since the dealers, they are not contributing anything to the coffers of the to the tax coffers. Thank you, Chairperson.
Thanks, Simon. Next, Dennis. Next, Willie.
Yeah, thanks very much, Chairperson. Thanks for the presentation, Treasury. Yeah, I think it's going to take us a bit of time to work through it, and I'm sure there'll be a lot more interrogation of it as we go through and more details come out. So the first thing that I'd like to say is that, yeah, so the tobacco and non-tobacco slide that you guys had on your screen, I don't think it was a pack that got circulated before. And yeah, it was very possible that I was slightly distracted at the time that you went through it, but I didn't get enough on that tobacco and non-tobacco issue. I thought that one of the issues around non-tobacco products was that they were a healthier alternative and certainly used to wean tobacco addicts off of their nasty habit. Now, as an ex-smoker myself, I understand it's a difficult process and so on. Are we starting to tax the two the same? You know, is there a tiered approach to it? If you can just give me some ideas around that, please. Then the issue around variable remuneration, I think is quite an important one, and I think I'm going to ask that we focus a little bit on that in the days and weeks ahead, because I do think that, you know, when we're starting to change the taxation regime around insurance companies. You can be guaranteed that there's an army of attorneys and so on involved in interpreting the rules and so on. The beneficiaries or the earners of variable remuneration certainly don't have the same backing and the same level of ability to participate in our parliamentary processes and have their inputs. And so I would like to understand a little bit more on that. I will certainly reread what has been presented, but I think that we need to make sure that we understand that properly for the benefit of the people that are remunerated in such a fashion. The IFRS 17 amendments on the insurance, I think is quite interesting. I'd like to hear, so there's a phased-in approach. I'd like to hear, has there been much consultant with, for example, SAICA and so on in terms of the implementation of this from an accounting standards point of view? I understand that the insurance companies may not like it, but let's hear what the accountants think about it. The question of what is an invoice? Surely there's international norms and standards that apply. International trade. I remember when we were doing letters of credit in the bank 400 years ago. There was always, the documentation was the key issue. It was at the core of the transaction. Surely there's international norms and standards, and don't we have international trade agreements that determine what is an invoice? Because it's an intriguing question, certainly in the modern space when we have electronic trade happening at the rate that it does. Yeah, I'm surprised that we still have to ask that question. And then I think the issue, the question around advanced rulings, I think should be welcome, because if there's one thing a businessman likes, it's certainty. Whether it's good news or bad news, as long as it's certain, I think it's good. Yeah, I was a bit surprised to hear that there was some negative feedback on that, but then I understand that it's about being able to access that properly. And I just wanted to say I'm quite pleased to see that there's been some agility in this, but in fact in a number of issues that have been put forward today, where there has been positive response to feedback received. So well done. Thank you. And yeah, let's interrogate it as we go along. Thanks, Chair.
Next. Is it Willie?
Yeah, thank you, Chair.
Funny.
Chair,
yeah,
it's Willie speaking. Chair, you can just imagine.
Why are you so happy, Willie?
Say again?
Why are you so happy, smiling?
Because I know that things are going to change in 2024, but let's stick to this meeting now.
You wish.
Chairperson, if you say that this is technical, just imagine how this Afrikaans-speaking boertjie from the Kalahari must feel on all
you
what
might be offline to tell you a saga about the tax, the rates, what is it? Public municipal rates bill, right? And the language use, and the South African Agricultural Union and the Transvaal Agriculture and the issues there one day when we offline. Okay, go ahead, please. Let me not hold you
up. Thank you. Chairperson, yeah, thank you. I have been covered with regards to the nicotine and tobacco industry by Dennis. With regards to the fuel price levy, we know that due to what's happened in the Ukraine and the higher oil prices, we had huge increases, and those fuel levies were waived for a certain time. The question is still, are those fuel levies or a huge percentage of them still necessary? If you look at some of the proposals that were made with regards to looking at RAF, Road Accident Fund contributions from people that have got private insurance, if you look at the deregulation of the industry and what effect that will have on the fuel taxes and on the cost of fuel price to the people of South Africa. I think it is time that we need to relook the whole levy system that is applied when we are talking about fuel in such a way that we can get rid of taxes that are levied on every liter of fuel that is bought in South Africa, where those taxes are already being covered or can be covered in other ways. I would just like to have Treasury's remarks on that. With regards to the two-pot retirement system, firstly, my question is there a reason why it's only going to be implemented in 2024? And then another question there is, they spoke about legacy retirement annuity funds. Now, maybe I missed something. I would just like to understand exactly what is legacy retirement annuity funds. Then with regards to the carbon tax and some incentives that is given to Eskom, what is the incentives that or tax deductible allowability that will be given to private individuals? If I put a solar system on the roof of my house and in such a way I am contributing to having a cleaner energy usage from myself, would that be allowed as a tax deductible, or would I receive some incentive? And I use myself as an example, but I mean anybody out there. Then a last thing that I did not see here, and I think we need to really look into this. We read daily about farm murders and crime in the rural areas of South Africa. Now, I'm coming from a province, the Northern Cape, which is a very rural area. Places are very far from each other. And the police services in those areas just cannot cope with the crime in those rural areas. Now, the question is, the cost that people in, especially our rural areas, have towards keeping themselves safe because the police can't do that anymore. Are Treasury looking into having a tax deductible system implemented with regards to the cost that people in our rural areas, and I'm not only talking about farmers, I'm talking about everybody in the rural area, that they can get tax deductibility for the cost that they incurred with regards to keeping themselves safe. Thank you, Chairperson. I will also take maybe a day or two, maybe a week or two to go through this again and try to understand better what's going on here, but thank you very much. I appreciate it.
Chair, thank you. I'm covered on the tax incentives for individuals with regards to private power generation by Honourable Billy Ockham. Thank you, Chair.
Thank you. Basically, look, I don't have much to say because I must confess I need to look at it more carefully. Yeah. Oh, yes. Who's there?
There is Ms. Makango as well.
Okay. Over to you, Comrade.
Thank you, Chair. Let me join the honorable members by welcoming the presentation. And truly, as you said, very technical. We appreciate, I want to appreciate the extent at which they go to make sure that they do a thorough consultation. And even when the insurance companies were saying they don't want or they can't be in the same session, they can't be consulted on the same session, they were able to accommodate them. And I think that needs to be appreciated, that you're making sure that people do understand this. I just want to comment also on the issue of the temporary relief or something like that. You're talking about the temporary relief on the tax. And if it's temporary, I don't know during the consultation as to how long is the temporary, the duration. And I also think that we will also, as this is work in progress, we will still have to consult and agree with the chairperson that the support staff will also have to make research and analyze what you will be doing. I mean, you'll be presenting. We will also try to familiarize ourselves with the ZO. I know as one of the people who have been struggling with this. I'm not a tax specialist, but one can really see the good work that you're doing, but also considering that the public, the stakeholders that are playing an important role needs to have an understanding. The issue of the incentives, the pension, the pensions, and other things that who is allowed, which one is allowed to be deducted from, and how long. I think it's something that raised my eyebrows, but as I serve in the board of the pensions members' interest, I will also consult on the matter. It's work in progress, and thanks for the presentation.
Thank you. So firstly, I must confess, as I said, that I read through it very quickly this morning, and then I listened to what Younger and you and others have had to say. So I just want to make clear, because I think I've got it wrong, and I just want clarity. So what you're doing is you're going to be introducing a TLAB bill with the budget in February next year. Am I right? Dealing specifically with the retirement issue. Is that correct?
Yes, Chair. It's not going to be introduced in next week during MTBPS, because we still need to do more consultation, and then we're going to introduce. Yeah.
Okay. All right. We welcome that. But before I get into the issue itself, so as I understand it, all the other issues, as amended through the SCOF process, will be processed except for the section that deals with the retirement savings. Is that correct?
Yes, Chair, except for the two-pot retirement system. It has got a separate bill.
Okay, good. Now, firstly, on my own behalf, I don't know what the majority think, but we will work it through as a team. I think it's a good idea that you engaging more with the unions and other stakeholders, okay? Because it's a big measure to take, and we don't know what the consequences will be in time to come, partly because we're living in such volatile, unpredictable, uncertain times, not just here, but globally, right? So I think that's to be welcomed. But what I wanted to ask is, particularly with the unions, obviously the pension fund people, the employers, all have to be taken into account, the broader needs of the public fiscus and whatever, and the need to ensure that people do have retirement savings so that they don't draw unduly on the social welfare system, strained as it is of our country, right? Now, by postponing it for a year and looking at what seems to be looming, given the war in Ukraine and other considerations, the absurdities of what's going on in the UK, no less, and the consequences of that globally and in our own developing countries. The question I want to ask you is, this 1 year delay, are the unions okay with that? That's the first question I want to ask you. Secondly, I don't fully understand. I follow that very carefully, right? But I don't fully understand. And I read the slides, right? So if I understand what you're saying, am I correct to say the vested part is everything you have until the moment this proposed amendment, which you're going to introduce after further negotiations in February next year, comes to the vested pot is what you have up till now. Then you have a savings pot and a retirement pot, right? So the saving pot is where the amount you can draw from, let's say if your pension is 10 rands, you can draw 3 rands, up to 3 rands, but a minimum you must have in it before you can draw that. And that's the savings pot. And the retirement pot is what's there that's left for you when you finally retire. Is that a correct, even if slightly over-condensed explanation? That's all I have to ask for now.
Yes, Chair, is the correct explanation. You've got it, but
Okay,
Basil
good.
will expand.
Right. Now, you explained, your colleague did, what some of the issues are. And at the moment, I mean, the unions generally, are they reasonably, they will have their differences, different federations, and even within a federation, different unions, because, you know, it depends on whether you're a teacher or whether you're a whatever, right? Just as a sector of the labor process or of the, you know, public service or workers generally. The question I want to ask you though is, are they relatively united in their approach, or are there still divisions that have to be sorted out amongst themselves? Hello? Anybody?
Okay.
It doesn't have to be younger. Yeah.
Okay,
Do you
thank
understand
you,
my
Chair.
question? Yeah.
Yes, they are the unions united in their approach.
Oh,
Chair,
good. All right. Yeah.
yes,
But-
Chair, Basil and Alvina can come in as well as Chris, because
Okay.
discussion has been held with NEDLAC and Matthew Parks have been instrumental in this.
Yeah.
So we are of the view that there is unity.
Right.
That said, there were questions that were asked regarding the seeding that were asked by the bargaining council. But after explanation, I think there is an understanding of what seeding means. But both Basil and Alvina can come in. But based on the discussions with NEDLAC, and Matthew Parks came to the public hearings and they welcomed the proposal.
Okay.
Yes, Chair.
All right. Now, do the other two want to come in? Just very quickly, I should have explained this at the outset. I have a practical problem related to actually my parliamentary work. So I'm going to leave at 12:30, but I spoke to both Mamora Khane and Comrade Jadu, and both said, fine. So Mr. Jadu has now agreed to chair if I have to leave at 12:30. But I think we can finish before then. But look, it's over to you. It doesn't matter whether I'm here or not, the meeting goes ahead, right? I'll catch up. Okay, I see a comment here in the chat group quickly. What is it? We have load shedding. I will have a try to connect with a different device. Okay, thank you. We're at level 4 again. All right, go for it. The other two colleagues, do you want to say anything?
Yes, Umpo will go for regarding the tobacco, illicit trade and vaping, and then Chris.
Yeah, no, I'm talking about this issue. This issue, they don't have anything to say. All right, fine. Okay, then you will obviously coordinate your team. I'll leave it to you. I'm not going to interfere unduly. Go for it. Respond to all the questions. Thank you.
Thank you, Chair. Umpo, over to you.
Thanks, Chair, and thanks, honorable members, for the questions. Regarding illicit trade on tobacco products and alcoholic beverages, yes, we, as government, we are concerned about the problem, and we acknowledge that there is a problem of illicit trade, which undermines both the health and excise policy objectives that we have. However, there's been a lot of work that the South African Revenue Service has been doing regarding clamping down on illicit trade on excisable products, and there's work that is coordinated with other law enforcement agencies, with the group that has been established within SARS that deals with illicit economy generally, and they are doing quite a lot of work to clamp down on illicit trade. And as the commissioner of SARS has said, that as part of the strategic objectives is to make this illegal activities quite difficult for those that are engaged in those activities, and SARS is doing quite a lot in putting measures in place to deal with this problem. With regards to the question on electronic nicotine and non-nicotine delivery systems, well, there is this claim that has been put forward that these vaping products as tobacco cessation products, but as of now, these products are not recognized anywhere as tobacco cessation products, because unlike your the already existing products like nicotine replacement therapy and tobacco gum and all of that have been thoroughly tested and authorized as tobacco cessation products. These vaping products have not gone through a similar process, and therefore that's the claim that is made by the industry, but there's no authority that recognizes these products as tobacco cessation products. The World Health Organization doesn't recognize products as tobacco cessation. And again, in other jurisdictions, if you look at the US Food and Drug Administration, also they don't recognize this as tobacco cessation. And also the report of the United States Surgeon General in 2020 basically making the same assertion that these products are not like the other products that are recognized as tobacco cessation product, because they've gone through a thorough process to be authorized and approved as such, and vaping products are not. Thanks, Yama.
Thank you, Chair. I think the next question from Honorable Ryder, because Mpho is done with the question both from Honorable Malitsani and Honorable Ryder. The next one is on variable remuneration. Do you want an explanation? I think you are welcoming this. Maybe Zalisile can say, maybe, I think this is based on the public consultation and all the issues that were raised. Zalisile, can you please come in there a little bit?
Yes, thank you, Yanga, and thank you, Honorable Ryder, for the question. You want to understand what this really means. I think, to put it simply, is that you can't tax an amount that the employee is not entitled to. That is what is been spoken of in this amendment. That especially if that payment depends on a happening of a future event. So what this proposal actually means is that let the future event take place, and then you can impose a tax at that point when the employee has received the payment. That's what this actually means. And it actually means that all employees that are receiving performance-based payments, whether those payments are calculated on the basis of a percentage or are calculated on the basis of what has been produced and how much has been produced, is it won't make any difference from this point going forward. Is that we wait for the event to happen and then we tax at that point. That's what this means. It benefits the taxpayer, if I can put it like that. That we are not going to be taxing on accrual when there's an entitlement, because in these instances, there is no entitlement for the employee to receive the amount at that point, unless that employee's work has been looked at and reviewed, and that person who's reviewing their work is satisfied that they have actually delivered, and what they've delivered is final. Only at that point, you impose the tax. Thank you, Yang.
Thank you, Zalisile. And then Tlanhla on Ifrs 17, as well as consultation process with SAICA. I think if I can come in, is that when we did the consultation process, SAICA was in, but we did receive a lot of comments from the ASISA and SAIA, of which they are organizations that are dealing with insurance companies. And within those insurance companies, in their tax departments, they've got the CA as well as accountants. So we think we have consulted, and during public consultation, SAICA was present, but you find that since SAICA is an organization, they receive most of their comments from these insurance companies or from the tax practitioners. Nhlanhla, do you have anything else to add?
Not much, except to say that generally the auditors like your PwC, your KPMG, they then generally, when they send comments, they do say that they comment on the Ifrs 17. And then of course, SAICA has been part of it. So they do generally attend. So other than that, yeah, that's all.
Okay, thank you. The next question from Honorable Dennis Ryder is on TALAB, France.
Thanks, Yanga. So the question turned around, is there not a standard for an invoice? And the difficulty is that it's a commercial document, and there's a question of how much detail you require in the document and how much detail SARS is able to obtain to determine the correct customs valuation of the product given the customs valuation rules. And that's where the difficulty arises. So yes, it's a level of detail question that comes into play here. So that's why we need to regulate it. Thanks.
Thank you, Franz. I think the next question from Honorable Vili goes to Chris, the issues regarding the fuel levy. Thanks.
Thank you, Yanga. I think the questions were, is the fuel levy still necessary? The problem we have is that the fuel levy is the fourth largest revenue item on the budget. So it's, we're expected to make about 40 billion from that. So getting rid of it would leave a very large hole in our overall revenue collections. And it's quite a difficult thing to do. Even the relief we did for 4 months this year cost 10 billion, which is also a considerable amount. If you think that each percentage point of that would raise about 25, a 90 billion rand loss is quite a large increase in the VAT rate if you're going to make it up, say, for example, that way. So, but it is something we really are thinking about. And in those previous media statements we put out, we put forward the different options that we're trying to consider to then try and reduce those prices over the longer term. Looking at the RAF levy, which is because it's earmarked and it's linked to the road accident fund, it really is about the reform of the road accident fund. And the policy of government has been to try and move towards this road accident benefit scheme, where the road accident benefit scheme bill was in Parliament and should really be retabled in Parliament and looked at again. And the actuaries thought that the cost of running the road accident benefit scheme would be lower, so that it could provide some space to potentially lower the RAF levy in the future. That is the one thing. The other was on deregulation. We did want to try and move forward with deregulation. Treasury was supportive of that move by DMRE, which was their proposal. DMRE have started consultations and have put out draft gazettes on that process. The industry are obviously concerned that this might have an impact on jobs in service stations. But we do believe there could be wider economic benefits and to households and businesses from the potentially lower price of that deregulation. It is only for 93 unleaded petrol in Gauteng, but you could always look and see how that goes and then potentially think about deregulation for wider areas and for 95. So it is a difficult one. We are looking at it. The other issues we're looking at were the margins. So DMRE are doing a review of the regulatory accounting system, which does look at the margins within the fuel price that could potentially go down. If you move to deregulation of all of it, then you wouldn't have to worry about what those actual values are, because prices could adjust in the market itself. Thanks, Yanga.
Thank you, Chris. The next one on Basel, the explanation regarding legacy retirement funds.
Thanks, Yang. Thanks, Chair. I think the first question was on why we are moving the date to 2024. It's a big change in the retirement system, because the retirement funds would have to change their system so that they can allow payments other than at withdrawal when a person retires or resigns. So now they have to create this kind of a system that makes retirement funds look like kind of banks, but on a once a year basis. And then secondly, they have to educate their their members about how the two-pot system is going to work. And then thirdly, they have to train their own staff about how the system is going to work. And then on the legacy retirement funds, these were insurance products whereby on signing up your contract, your insurance makes a promise about what it's going to pay when you reach the agreed age.
Sorry, can you put your video on? Look, I don't care much about that, but the authorities in Parliament, they prefer you to keep your video on when you're speaking. Although if you can't, you can't. Sorry.
Okay.
Yeah, that's not my decision, right? It's the powers that be in Parliament. Sorry.
Okay. So we're saying the all generation insurance funds were, retirement annuity funds were created before 2004. They are no longer the same structure, so they're no longer an insurance product like they were before. So the problem is how, if somebody still contributes to a retirement, an all generations retirement annuity fund, how would you split the contribution into a savings pot and a retirement pot, but the insurance company still keeps the promise that they made at signing up of that contract? Thanks.
Thank you, Chair. The next question was on carbon tax. Over to you, Charlene.
Thanks, Yanga, and thanks for the question on the incentives. So the renewable energy incentive that's available to Eskom for purchases under the Renewable Energy IPP program is also available to any other electricity generator, whether they're operating in a manufacturing, whether it's in the petroleum industry, iron and steel, cement. So they are also eligible to claim this deduction against their tax liability. We've also now just extended that to include commercial and institutional activities, as well as agriculture, forestry, and industries as well. So to the extent that they purchase additional renewable electricity, this can be offset against their carbon tax liability if they are a taxpayer. The second incentive that's currently available for renewable energy projects under the carbon tax is that we have an offset allowance under the carbon tax. So renewable energy projects that are less than 15 megawatt install capacity, those projects can generate credits, which can then be sold to high carbon emitting taxpayers to reduce their tax liability. So these projects can be developed under the Clean Development Mechanism, the gold standard, or the verified carbon standard internationally. And those savings that are calculated can be, and credits can be sold to taxpayers to reduce their liability. We are also in the process of finalizing a framework for developing a local carbon offset standard that will also make it much cheaper for potential project developers and taxpayers to basically generate these credits from renewable projects. And the third area that there are incentives for renewable energy is we have in place a renewable energy depreciation allowance. So it applies at the rate of around 50, 30, and 20% over 3 years for capital investments that are made. So those costs can be written off. But there's a special dispensation for solar PV, and this was introduced around 2015. So for that, allowances, instead of writing off their capital investment costs over 3 years, they can write it off immediately over 1 year. And that currently applies for projects that at the time it was 1 megawatt, so aligned with the NERSA licensing threshold. So there is further work is being done about the potential to expand that. Thank you.
Thank you, Charlene. I think, Chair, we've covered all the questions.
Chair, sorry, my question
Yeah.
with regards to the cost for rural safety deductions has not been answered.
Fine, please do.
And I see a hand from Mr. Ryder as well, Chair.
Yes, Mr. Ryder.
Thank you, Chair. I have two follow-ups, if I may. So the first one, Mr. Axelson triggered something that should have been probably the first question we asked today. And that relates to the e-tolls project in Gauteng and the fact that there is substantial speculation that e-tolls is going to be replaced with some other form of a tax. There was reference to obviously Gauteng. Now I understand already there's a reef premium that gets paid on fuel, etc. But you know, I didn't see any mention of anything else that came in specifically dealing with the Gauteng matter to fix e-tolls. And then Ms. Suraj, just I think that you detailed clearly what the benefits are, tax benefits to commercial entities, but are there any tax benefits to individuals who go the route of solar generation, etc., in order to improve greening? Thanks, Chair.
Over to your team, Younger.
Thank you, Chair. With regard to the rural safety, cost on rural safety, we've seen the articles, security should be tax deductible in South Africa because government has failed to keep us safe. We have seen those articles, but we just want to state that if you are a business conducting business, then that can be deductible in terms of the general business expenditure in terms of Section 11A. And if you have installed security, it can fall under capital allowances. It depends what type of security. Is it a capital expenditure or is it a general business expenditure of paying the security company for business purposes? However, that said, for me as an individual, there are currently no provisions for the deduction of security in the Income Tax Act. It is not designed in that manner because it is a personal expense. Thank you, Chair. Any other comments, maybe Chris or Franz?
Maybe I can come in there on a couple of the questions. On e-tolls and GFIB, if the members could just wait for the MTBPS by the Minister next week, hopefully there can be an update for you there. Also on the deduction for private households and on security, I mean, those would be two changes in policies. So those are things that we would look at for the budget. I do know from the President's initiatives on trying to restore energy security that has been put forward as an option for National Treasury to investigate in terms of allowing potential incentives for own generation. So those are things that we are looking at, but they would only ever be announced by the Minister in the budget. I think that covers them. Thank you.
Yeah, that's in the media. By the way, you may not know this, Chris, but it's a very strange thing. I've not seen this before. You appear like you're behind a sort of like mist of smoke or whatever it is. I'm not sure why. It's probably something to do with the... I've never seen it. It's very interesting. It was early as well, but I didn't want to disrupt you. Oh, now it's appearing. Now you are. Oh, it's just you. And you obviously know about it. Oh, I've never seen that before. It's not important. The content of what you say is important, right? Okay. And over then to Younger, is there anything else you want to say?
No, Chair, nothing else.
Right.
I think we've
now,
covered
members, do I take it we're done for now? Basically, look, you know, it's very early days and see what happens to the public hearings. But in the meanwhile, it's given us some space Dennis, you've got your hand up. Oh, you're saying, okay. All right. So you know what? Also, Poppy and her team must get together as well. And we can talk offline about when you get something done. Please, members, note that we have lots of bills this quarter. Not least, we have to deal with the MTBPS. But beyond that, there are all these bills. So we will have to meet more than just our Tuesday sittings, but you have a draft program and we'll adapt and adjust it as necessary. And so may I thank you and thank Comrade Jarif for offering to chair if I went beyond, or we went beyond 12:30 or 12:15 to 12:30. I thank you all. I shall see you whenever. And we're in appropriations tomorrow anyway. Keep up. Bye then.
Thank you, Chair.
Thank you very much. Thank you, Chair and honorable members. Thank you.
I was in the meeting on the road.